Morning, everyone. Good morning, Dave. Welcome to the ReadyTech Remote Control Series, episode 14. For those of you who join us for the first time, my name is James Horn. I'm the Commercial Director at JobReady. This is Dave. We've got a slide to introduce Dave in a second. But before we do that, a couple of housekeeping items to cover off. So the first is today's session is about 35 minutes. With Q&A at the end, where we'll be hearing from David walking through the RTO financial guidance and what to do and what to consider and how to prepare for coming out of COVID-19. Q&A is either, depending on your config, will either be at the top or the bottom of your screens. I will be moderating the Q&A whilst David takes us through his presentation. If there's anything that comes up that's really appropriate and pertinent, I will jump in and we'll tackle that question live. But if there's, there's sort of broader questions, then we'll just put them in the Q&A for discussion at the end of today's presentation. So, David is director, is also an accountant for RTO accountants. Formal welcome, Dave.
Hello, James. Thanks for having me.
Absolute pleasure. And I'm going to just throw over to Dave to sort of walk us through his background. But the motivating factor for today's session was really about trying to bring as much information to you guys about what you need to be considering, what you need to be aware of, and really some practical advice and guidance around some strategies and some activities that you can implement over the next short to medium term to make sure that you're really well prepared to close off this financial year, and enter next financial year as strong as possible, particularly off the back of the COVID-19 as we start to surface from that experience. So I think it's really topical and appropriate. So David, just to throw over to you formally, I'm going to make you our host today.
Yep.
So I'm going to stop my share.
Yep.
And let you pick up sharing responsibilities.
How does that look?
Seamless, just like we did in rehearsal.
Yeah, I'll just put it onto the. I'll just change the view for a slideshow.
Yep.
All good. Does that look good?
We're on the episode 14 slide.
Yep.
There we go.
All right. Well, thanks, James, and thanks for the introduction, and thanks for letting me present on this topic. And good morning, everyone. And I hope everyone is seeing a little bit of light at the tunnel. If they've been heavily affected, which a lot of colleges have been, by COVID-19. And here's a spiel about myself. And so I'm a director in RTO accountants, but I've had a lot of experience in both public practice at KPMG, and then also in commercial organisations like Citigroup and CBA. And and we've had an accounting firm since 2001 that does all your accounting firm stuff like bookkeeping and accounting and business advice and structuring your business. And we've been involved in RTOs for probably the last 6 years. I guess we started getting a few RTO clients just organically, and kind of worked out that there was it's quite a specialised area, and it's become a lot more specialised in the last few years as the industry and the sector becomes more specialised, especially with things like the FVRA tool, which is very specialised. And just before I start this is all just, you've probably heard all this before from people like me. This is general advice, and it's a kind of thing that every organisation is different, and every business is different, every individual is different. And what we're talking about here is, generally, we're trying to cover, tens or 20 different types of businesses and hundreds of different types of organisations. So we're just speaking generally to give you ideas about what you should be thinking about when you're looking at the other end of this, the other side of a downturn in your business and a changed environment. So as is the case at any time, financial success is critical to running your business, and that hasn't changed. There's just been a lot of changes to the financial affairs of RTOs and businesses and the economy in general with the onset of COVID. And another thing that is also critical to success is planning. So planning, it doesn't matter what we talk about. And yes, you do hear success stories where people don't do any planning and they just wake up one day and walk down the street and, you know, come up with a brilliant idea, and there's no planning and there's no hard work. But those stories are few and far between. So planning is something that is ingrained in most business people, not only in how you're planning your operations and your strategy for the future, but you've also got to have an understanding of planning your financials and understanding the future of your financials. Lots of things have changed, which is making planning even harder than ever. And for a lot of people, a lot of businesses, a lot of people have a lot of trouble, and planning is one of those things that it's always, people think it's important, but it's not urgent. It's never, it can be considered never urgent to do your planning. But, planning for success and planning for the future is probably one of the most valuable things you're going to do in your life and your business. And I'm not the first person that you've heard that from, but it is something that is, something that you need to motivate and kind of keep in the quadrant of something that has to be done, whether, it is something that you can keep on putting off, but it's probably going to be to your detriment in the long run. And also in this new environment, we'll just talk about the support that's available for businesses and RTOs specifically. So that is also important because that's part of the new landscape, at least the landscape for the next 6 months, and who knows how long some of this support might be around for. So we'll talk about the support, which I'll just cover some of the basics. I think everyone's heard about all the support, so we'll just cover that quite quickly. Then we'll talk about financial planning in RTOs and some of the, we've only got 30 minutes, so this is going to be pretty quick because we could talk about each of these topics for a few hours each. And then we'll talk about board reporting, and board reporting kind of, there's no use doing planning and, predicting what your entity is going to do and plan what's going to happen and just leave the plan to sit there. If you're going to plan to do something, you need to monitor the progress of your plan and how you're tracking, how your actuals are tracking to the plan you had. So JobKeeper was the largest of the government stimulus. And I guess the government's slight error here of $70 billion or $60 billion made us all feel a little bit normal. And it seems to have given the opposition a great avenue to attack the side of politics is supposed to be the best economic planners. But initially they said 6.5 million people. Now that's down to about half, 3 to 3.25 million people they think will get JobKeeper. It's going to cost, the government, taxpayers, $70 billion. To be eligible, you have to show a 30% reduction in revenue or more. Won't go into the details of that, but basically that was initially the basic rule is 30% revenue reduction compared to a similar time last year, a similar month last year, but there are alternative tests to allow for other entities that have just started their operations or who have had rapid growth in the last 12 months to show a 30% revenue reduction related to what's happening with the economy due to COVID. And if you can prove that and you have eligible employees or a business participant, those eligible employees and the business participant will get $7 you'll receive $750 per week for each eligible employee. And all of that has to be paid to that nominated eligible employee. Even if they're only earning $200 per week, they have to get that $750 per week. But you also, in these times, you have the negotiating ability through Fair Work for those $200 per week employees. You have a added sting in your negotiating power to get them to do more hours to earn that $750 if reasonable. And Fair Work also allows you to negotiate with other employees who may have earned a lot more than $750 per week to renegotiate their work hours and work pay closer to that $750 per week minimum you need to pay them. So basically these JobKeeper payments will go from the time of revenue reduction was proven till the end of September. So if you can prove revenue reduction in March or April, you'll receive this for April through to September, which is 6 months. And basically, sorry,
Dave, just one question from Robin. Are you aware of when the May JobKeeper payment is due, or is there a declaration required for May?
That's right. So at the start of every month, you do a declaration for the prior month and one for the future month, forecasting what you think your turnover is going to be. Yeah. As soon as your declaration goes in, I understand you should receive the funds for the prior month within 7 days.
Okay. And
the ATO does have a website, a page on their website which says when they think payments will be made, but they are, from my understanding, they're being pretty prompt. As soon as you put in your monthly declarations, they're kind of turning it around within 7 days.
Okay.
And so basically, yeah, there was an enrolment process, and then you need to do the declaration every month, which Robin alluded to, is basically the declaration does not affect your ongoing JobKeeper eligibility. It is basically an information collection process for the tax office. So they just want to kind of see how businesses are actually doing. So if you're worried about your declaration and you think your business is coming back and getting strong, that's fine. It's not going to mean that if you declare your business has gone up 100%, that they're going to take JobKeeper off you. So, and also there's probably a little bit of concern about the declaration every month. And just obviously you can't predict at the start of the month of June, like next week when you're doing your declaration, if you're doing the declaration for the month of June, you're not going to really know how June's going to go for you. A lot of businesses won't. So just, your estimate is fine, right? The next month you can tell them what you actually did make, and they don't expect much more than that. Okay, the next one is the initial stimulus, which was announced, which was the pay-as-you-go cash boost, and this is through the pay-as-you-go withholding system. Basically, employers withhold tax on the payments made or the salary and wages to employees, and that pay-as-you-go withholding tax is normally remitted to the Australian Tax Office via your reporting on your business activity statements or instalment activity statements. Under this stimulus, these payments, each employee can get a credit of $20,000 to $100,000 over the next 6 months. So basically, you don't have to pay the tax on the wages. So basically, it is reducing your cost of employees by the amount of the credits you're given. So instead of having, if you have a staff member who's on $60,000 or $60,000 over the next 6 months, or $120,000 over the full year, that staff member, on $120,000, their tax is probably something like $30,000. So they actually get $90,000. A staff member like that, if there weren't many other staff members, is going to now effectively cost you for that period, not 60,000 gross, but $45,000 gross, because you're actually not having to pay the pay-as-you-go withholding on that staff member's salary. It's a kind of basically, it's a saving on employees. And so this effectively is going to reduce the cost of your staff by the value of the credit received. And it goes up to a maximum of $100,000. And even for small businesses that only have one staff member, and if you're not even withholding tax on your staff, you'll still get the minimum credit of $20,000. And they've kind of changed the rhetoric on that. And so initially they were going to, using those credits, they were going to apply those credits to any debt you had with the tax office. But now they're saying they're going to refund. If you end up in a credit situation after they apply these credits, they will refund the money to your entity. So, which is better, because they were initially going to offset it against any other tax office debts you had. So other support, so there's lots of other support. So state governments, if there's a small business grant, if you're under, like in New South Wales, for example, a small business grant of $10,000, if you've had a 75% reduction in revenue, and you're under the payroll tax threshold, and if you did pay payroll tax, basically you don't have to pay payroll tax for the June quarter. So that's effectively a 25% reduction in payroll tax. But there's also other states have also got similar relief, and most states have other fee relief. Relief is in regards to other fees you might pay to the state government. There's also rental relief codes. So these are legal codes. So this is one area that's been very confused, because the states enacted all their own codes and relief. So an example, in New South Wales, they've got a default code. If you can prove via JobKeeper and your activity statements and financial information to your landlord that your revenue has gone down 40%, according to these legal codes in place, that would give you the ability to go negotiate with your landlord, in relation to this 40% reduction in rent, that 20%, you have a complete 20% reduction in rent, and another 20% could be deferred till 6 months or whenever your business becomes more viable and more financial to be able to pay that other 20%. Saying that every negotiation is specific, but it is legal, and that does have a lot of oomph and a lot of protection if you are a business paying rent. And you basically cannot be evicted under these if you negotiate in good faith, you should not be able to be evicted. And then we've got the Fair Work. So Fair Work allows you to negotiate all sorts of reduced hours, get your staff to take annual leave and only get them to take half their normal hours. So there's all sorts of relief under Fair Work, which allows what would not be heard of arrangements be possible to keep your business alive and also to keep your staff employed. And there's also finance relief. So the banks are deferring interest, deferring payments. The bank relief is temporary, and in the long run, you will still owe as much as you ever owed. So you're not actually going to get away with reducing your debt forever. ASCA's got fee waivers. So I think the only fee you have to pay for ASCA now is initial registration fees. Suppliers can be negotiated with. You're probably using your suppliers less than normal. And then there is also funded training for affected areas. So the state training authorities have released a lot of programs to invest in training and subsidise training, which should also allow some RTOs to get a flow of students that way. And as you may or may not be aware of, on Tuesday, Scott Morrison, the Prime Minister, also announced an overhaul of training. He didn't, in that speech on Tuesday, specifically talk about more funding to training, but then subsequently he has said that is on the table, that there will be more funding to training. But I think their main objective there, reading between the lines, is to get consistency across the country in, you know, the skill shortages, and make sure that the training that is being provided is in line with industry demands, and it's current and has currency. The training that vocational training RTOs are providing, and I'm sure a lot of people on this video, on the conference call, are saying they've heard all this before, and yeah, we have heard it all before. But I mean, in theory, you know, this is the time to do it. It is a time to invest in education and kind of get consistency across the states to, you know, make life easier for everyone.
Just on a couple of those points, Dave, if we can, are you aware of any expiry dates on, particularly around Fair Work and the potential adjustment to employees' hours and the use of annual leave and those sorts of things? Do you know if there's an expiry, or has the government announced when they expect that will stop?
Look, I don't know about Fair Work. I think a lot of these things, and even when they are putting in timeframes, I think there's a lot of flexibility in that.
Yeah.
Yeah. So even JobKeeper, which has got an end date 30 September, you know, but I think with JobKeeper, for example, they just might get more targeted to the industries that have been more, if they've got $70 billion positive mistake, they might use that to target the more harder hit industries. And with Fair Work, I don't know if they've got an end date, but I think with those kind of employment relation matters, it's all very fluid, and staff are always going to be protected, you know, and Fair Work is heavily good protection for staff. And this is the first time when I've seen Fair Work really benefit or be really show a lot of empathy towards an employer's situation, because it is so unprecedented.
Yeah, sure.
And there's another question there. I might just...
Yeah, Margot's just sent through a question. If you've met the 50,000 in the first quarter, ending March, are you still entitled to the next? Or do you
yep. Yeah, I think you have to wait till, I think they start paying. So it's a bit of an overlap. It's a funny system. If you look at the ATO website, so you've reached your 50,000 max for what they call the first tranche of payments, which would have been, the 50,000 was supposed to be related to the March and June quarter activity statements. But because you've hit your 50,000 at that point, my understanding is that then you'll get 12,500 in June, July, August, September. So you get 4 equal installments of 12,500 over June, July, August, September. I could be slightly wrong, but I might be 1 month out. But I think the aim of the system was always to get the funds out as quick as possible to the businesses, Okay.
Hopefully that answers that question, Margot. Thank you.
And yeah, so just now to talk about financial planning and RTOs, and I'm getting a bit conscious of time because kind of the fish probably only got really 10 minutes to go. So, you know, just for bang for your buck, when you're thinking about where to invest your time in planning and looking at your expenses, it's, you know, these 4 things here is just about everything for an RTO: course revenue, agent commission, staff rent. And sorry, I might, obviously look at your own profit and loss to see if I'm right or wrong. But really, when you're thinking about what you're going to spend time on and what you're going to get stressed about, think about this, because, some RTO, some business owners, RTOs might think, oh, well, I've got to look at my office expenses, and advertising could be significant too, but office expenses and travel, you know, like obviously you want to look after all your expenses, and, you know, a dollar saved here is good, and a dollar, you know, it's just as good as a dollar saved anywhere. But, you know, these 4 areas are where you really get your bang for your buck when you're really looking at trying to understand your business, and, you know, concentrating on reducing costs in these areas or increasing obviously your course revenue is where you're going to get the most, the net benefit of your time. So yeah, so I've had a lot of, in the past when we're talking to RTO, this is an area, and this is just an example of what we would call a course costings, financial planning for course costings. And look, and in this scenario, obviously revenue is revenue, and, you know, if you're charging 20 students at $10,000 per student, but then your teacher costs, you know, you might have in teaching costs, there could be contractors, they could be permanent staff. And so your cost could vary about, depending how many classes you have to hold and what additional time is required on top of classes. And you might only have room hire. So you might have 20,000 room hire, but you also might have occupancy expenses. And then your learning and assessment resources might be per student, they might be annual, you might have bought them years ago and don't pay anything for them effectively now. But you kind of think you don't pay anything for them, but there was a cost, initial cost. And you've got to always factor in these costs, because some of these costs are often forgotten, because you say, well, no, we don't, there's no cost for resources. We haven't spent anything on resources for years. But you really did spend money on resources at some time, and you need to be honest in your understanding of what it costs to make a course, because then in another year, 2 years later, you'll have to buy learning and assessment resources again. And then you'll just say, oh, the whole $10,000 was for that course. But it wasn't. The $10,000 you spent was really split up between 3 or 4 different courses over 3 or 4 years. And therefore the cost of that payment for learning assessment resources at that time in your business's life cycle was not for just one course. It should have been spread across 6, 10, 12 courses. But yeah, this is something that all RTOs should understand. And then if you just look at so if you come to a total, what we call direct costs. So this only looks at direct costs of providing a course, which gives you the gross profit of a course. But then you've got to look at overheads. And overheads are things like your back office staff, your advertising to get the students into into your college, your regulatory fees, your legal fees, your accounting fees, so much that are overheads too. And every business is run differently, and every business is set up differently. And so something like this, what I'm showing here is a template, but every course costing needs to be tailored to your business. And it's not an easy part of accounting. So it's not, even for a qualified accountant, it's not easy, and it takes understanding of your business, not just understanding of accounting to do this correctly, and an understanding of how you want to run your business. So yeah, what are we going to do when we start planning? So we've got to factor in the support. So, and some of the things we want you to do, or what I recommend, is you gross up the support. So government stimulus, rent, the income, basically the rent reduction. Keep your normal rental expense in there, because you don't want to kid yourself that your rental expense is not what it is. You want to isolate and show this support. So you want to see this, what we would call, you can call this government stimulus, rent, and the tax credits. You can call that something like COVID support, just so you isolate it and understand it is temporary, and you should not be relying on that forever. And isolate it. But you also, what you need to factor in your planning is if you have reduced your staff, you have to factor in and plan, how long you're going to have those reduced staff costs, and you have to plan them into your profit and loss forecasts. And things like if you have got interest or deferrals of interest and rent, you need to defer them. So you need to include them as an expense, but you have to defer the cash flow effect because you're not going to have to pay them for 6 months or so. And with the rent, you might have a reduction in rent, but that would be included in your income from, basically from COVID-19 income effectively. And the hard thing about this, and the hard thing in planning, which we talked about at the start, is more than ever, you're factoring in uncertainty. Like, financial forecasting is hard at the best of times, but you're also factoring in all the uncertainty of this. So there's uncertainty. So you're probably less certain. Most businesses are less certain about their student numbers, less certain about the staff they're going to include or have in the next 3 or 4, 6 months, less certain about what their business is going to look like in 6 or 12 months. And so, yeah, that's difficult, and it makes long-term forecasting even more difficult. And so there's things you might want to consider in doing this. And some of the things you consider is, short-term forecasting, only forecast for 3 months at a time or 6 months, rather than trying to forecast for a year or two. If you do forecast for a year or two, you're just going to have to revisit the forecast more often. And obviously revisiting the forecast is more effort, more time. Whether if you do it yourself or engage professionals to help you, your accountants or advisors, once again, it's going to cost money. So you just need to factor in all that, or consider what your plan is on all that, how you want to understand your business in the future. And some of the things which have, what we're worried about, I guess a lot of businesses more than anything, is cash flow. And so what do you want to do to help your cash flow? Well, a great thing is to have someone in your business or someone related to your business that is there in the background that can provide you support, financial support. And the government is also encouraging the banks to provide up to $250,000 of funding, which doesn't require any guarantees of your personal property and assets, which is also a great way to give your business a bit of a buffer. It is finance and you've got to pay it back, but it's a lot easier to obtain than normal for small, medium-sized businesses. And other things you need to do is review your course costs. And this is, something that, you should be looking at anyway. And review your student fees. You look at your student fees, make sure that they're costed at the right amount. And something like this is sometimes a good wake-up call to kind of give your business a shake, to really look at what it costs to provide your courses, and are you providing them at the right price. Obviously, you've got to look at what your competition's providing the courses at too. And review your operational expenses. And all these things. When I say review, you're also trying to see, when you're reviewing your expenditure, you're trying to see if you're getting the right, you're getting, are you getting what you're paying for? Are you happy with what you're paying for? And obviously, it's not just about going to the lowest cost provider and paying the least amount, because sometimes that is more expensive than getting a good provider. So you've got to obviously maintain your relationships and keep your good suppliers. If they cost a little bit more than the cheapest supplier, they're probably going to be better value for you in the long run. Another large expenditure like capital expenditure, you might want to review if this is the right time to do capital expenditure. If you've got the cash and you've got the funding to do it, might be a good time because you've got the time to do it properly. But if you don't, you might want to be a bit more careful with how much cash you're spending now. And the next thing, of course, like I said, if you're going to make a financial plan and do forecasting, you need regular reporting to monitor it. With our clients, we offer or do forecasting, and usually we do a year or two of forecasting, but I guess everyone has to adapt to the new normal at the moment. And forecasting for the short term and trying to get a forecast out for 3 or 6 months is challenging. And you might just look at some top line figures. But the thing about forecasting, if you do go through a forecasting process, you've got to do it well and look at your student numbers and staff numbers, and then those student and staff numbers and premises details, they're going to feed into your profit and loss numbers and your balance sheet and your cash flow numbers. And I guess what we try to do, we try to get away from spreadsheets and we try to show graphs, right? I mean, this is our standard type of reporting where we're showing graphs of what, so you're basically able to see trends. Obviously, not everybody's an accountant with financial background. And I guess what your accountant or advisor should be doing is if they get you into doing this kind of regular reporting, every session they have with you, so every time they produce reports with you and have a meeting, incrementally you should be understanding more every time you meet. So, you're going there to understand what the reports say, but you're also going there to understand, to get a better education in what financial information is saying. And it's all right to be naive about it. And, there's no harm in asking what you think might be silly questions. And you want to improve your understanding about financials and your business because, you're in business, right? So you're in it for the love of education and the love of RTOs and training and education. But if you let the financials slip, it's going to be stressful and a nightmare and a headache for you in the long run. And ASQA don't like it. The regulators don't like it. No one's going to like dealing with you. So you're keeping your business in good financial health. You can still have the other, obviously the main priority of providing education and providing good education and good training outcomes. That's great. And it's a refreshing thing about this industry I like. And that's something I like about this industry after going to accounting conferences and techie conferences. When you go to education conferences, there's a real passion. And it's not just about the money. But I guess from my perspective, sometimes it should be about the money a little bit more, just to keep everyone in business and you should be also getting a reward for the effort you're putting in and a reward for the risk you're taking of running a business, and understanding where you sit. And so getting reports like this so you can get a visual representation that you understand and can relate to. And just with reporting, you've got to do it. There's no use reporting on information that's a year late. So I recommend doing something like quarterly if you've got bigger demands, monthly. But for example, in March, you should, for the quarter ending March 2020, you should be getting reports on that quarter in April or May, only a month or two after you end the quarter. So you can make decisions and you make things, and because if you're seeing things going wrong or things you want to fix in the March information, you want to get on top of it. If you're bleeding money in one area, you want to do something in April or May so that it doesn't go on for another 6 months and you lose another 6 months paying salaries that aren't required or paying advertising that's not required. And it also gives you that ability, if you're seeing understandable information, it gives you that decision-making ability. And from that decision-making ability, from the accurate information, you can reduce costs, increase your staff, and then you can once again look at planning and forecast and get back to understanding your business and monitoring your business. I think that's it, James. I kind of had to go pretty quick at the end, but got there.
No, you've done well to rip through that, Dave. Thank you for that. We had some good questions come through. We do have sort of a few minutes spare if anyone has any other questions for David. But importantly, David's kindly offered to run a complimentary 15. I'm sure if it went into 20 minutes, it wouldn't be a big deal either, would it, Dave? You're not clock watching, are you?
No. The accountants don't clock watch. No timesheets here.
Definitely not. That's really, really generous of you. And I think so there's a lot of information in there to unpack, and we'll be sharing the recording of today's session and the deck, so you'll have that as a reference tool. But encourage you to reach out to David for that 15-minute chat to clarify any questions. I think particularly with the speed in which the government was able to roll out a lot of the stimulus packages, it didn't really give everyone time to deeply understand it, particularly if it's not your job. whereas David is kind of responsible for understanding that. So I would certainly encourage people to reach out and get clarification on some of the blurred lines with, eligibility or reporting requirements, or even things about understanding whether or not it's an incentive or a stimulus, or if it's something that you're eventually going to pay back, like the bank lines and the pause on some of those. So yeah, really, really useful, David, and I really appreciate you participating in the remote control series. I might just steal control back if you want to just unshare.
Yep.
Actually, I can do that. That's good.
I think I've given it back to you.
You have. And if I found a glitch in the matrix. Okay, just let me know when you can see my screen again before we all jump off. So, as I said, we'll be circulating today's recording and the slide deck, and just so you'll have David's details. And as many of you know, we're continuing to run the remote control series towards the end of the financial year. We have a couple more sessions booked. Next week is actually, tomorrow is actually the next session with Dr. Darren Copland, which is about student engagement and motivation in this new digital world. I think we've got a couple of hundred already subscribed to that. So I would definitely encourage everyone to join tomorrow morning at 10 o'clock. And then we have a panelist, subject matter expert, Mark Cameron from W3 Digital, delivering a session on digital transformation and some practical advice on how to tackle that. So yeah, be sure to join us again tomorrow and next week. And in the meantime, David, thanks again for participating today. I hope you enjoy your long weekend, and everyone that attended, thanks very much. And we will speak to you soon.
Thank you.